Slide 1. Course Overview. Hi, my name is Brian. Welcome to Chapter 5, Segment, Interim, and Integrated Reporting, in this Advanced Financial Accounting and Reporting course for BA Economics third-year students. We will explore IND AS 108 Segment Reporting, IND AS 34 Interim Reporting Requirements, and the fundamentals of integrated reporting frameworks. Slide 2. Learning Objectives. This slide outlines our learning objectives. You will understand segment reporting principles under IND AS 108, including identification and disclosure requirements. You will master interim reporting per IND AS 34, preparing and presenting condensed financial statements. Finally, you will analyze integrated reporting frameworks and link financial with non-financial capitals. Slide 3. Assessment Structure. Here we explain the assessment structure. The midterm examination accounts for 30% of your grade, testing theory and application. Case study analysis contributes 20%, evaluating practical skills. Group presentations form 15%, assessing communication. The final examination covers 35%, focusing on comprehensive understanding. Slide 4. Segment Reporting. Introduction. Segment reporting provides disaggregated information about distinct business lines to help stakeholders evaluate performance drivers. Under IND AS 108, the management approach aligns external disclosures with the chief operating decision-maker's internal reporting. This enhances transparency, enables better risk assessment, and improves understanding of each segment's contribution. Slide 5. IND AS 108 Core Principles. IND AS 108 requires the management approach for segment identification and reporting. Segments are based on how the CODM allocates resources and assesses performance. It mandates clear disaggregation by products, services, and geographic areas. The standard replaces earlier risk and reward methods with a structure reflecting internal decision-making. Slide 6. Operating Segment Identification. An operating segment is a component whose operating results the CODM regularly reviews for resource allocation decisions. It must engage in revenue-earning activities and incur expenses. Discrete financial data, revenues, expenses, assets, and liabilities must be available for each segment to support meaningful performance evaluation. Slide 7. Reportable segments. A segment is reportable if it meets any one of three quantitative thresholds: revenue at least 10% of combined segment revenue, profit or loss at least 10% of the greater combined profit or loss, or assets at least 10% of combined segment assets. Segments with similar economics may be aggregated. Slide 8. 75% revenue rule entities must report enough segments to cover at least 75% of total external revenue. If initial reportable segments fall short, additional segments are disclosed until the threshold is met. This 75% revenue rule ensures that major revenue contributors are transparent to investors and regulators. Slide 9. Measurement and Disclosure. Segment disclosures must include basis of segmentation, nature of products and services, segment profit or loss, and segment assets. You must reconcile segment totals to consolidated figures. Major customer revenues require disclosure. Measurements align with those used internally by the CODM for resource allocation decisions. Slide 10. Practical example. Conglomerate segments. Consider a conglomerate with consumer products, chemicals, agribusiness, hotels, and paperboards divisions. Segment reporting presents revenue and profit by division, highlighting top performers. This breakdown assists investors in assessing which business lines drive growth and where resource allocation may be optimized for better returns. Slide 11. Interim Reporting. Introduction. Interim financial reporting provides timely financial information for periods shorter than a fiscal year, such as quarters or half-years. Governed by IND AS 34, it requires condensed statements and selected notes. Regulators like SEBI often mandate frequency and filing deadlines to ensure investors receive up-to-date performance insights. Slide 12. IND AS 34. Minimum Content. IND AS 34 mandates condensed balance sheets, profit and loss statements, cash flows, and equity changes. Selected explanatory notes cover significant accounting policies, seasonality effects, unusual items, changes in estimates, and segment information. Entities may present interim reports as full statements or condensed versions per regulatory requirements. Slide 13. Frequency and Format. Listed Indian companies must file quarterly results within 45 days of quarter end and annual audited results within 60 days of year end. Banks file quarterly under RBI guidelines. Indus 34 primarily follows a discrete approach, treating each interim period as standalone while incorporating select integral approach elements. Slide 14. Recognition and measurement. Interim reports use the same accounting policies and measurement bases as annual statements, with year-to-date measurements. When precise figures are impractical, entities apply reasonable estimates. Special guidance addresses tax expense allocation, seasonal revenues, uneven costs, and contingencies to fairly represent interim performance. Slide 15. Integrated reporting. Introduction. Integrated reporting is a holistic framework combining financial and non-financial information to explain value creation over time. Developed by the IIRC and endorsed by SEBI for top 500 listed companies, connects an organization's strategy, governance, performance, and prospects within the context of its business model and capital resources. Slide 16. The six capitals defines six capitals that underpin value creation: financial capital, funds; manufactured capital, physical assets; intellectual capital, knowledge; human capital, people; social and relationship capital, stakeholder networks; and natural capital, environmental resources. Integrated reports explain how business activities affect and depend on each capital. Slide 17. Integrated reporting framework. The framework's guiding principles include strategic focus, connectivity of information, stakeholder relationships, materiality, conciseness, reliability, completeness, consistency, and comparability. Content elements cover organizational overview, governance, business model, risks and opportunities, strategy, performance, outlook, and basis of preparation. Slide 18. Non-financial disclosures. Integrated reports extend beyond numbers, encompassing environmental disclosures, carbon footprint, energy, water, waste, biodiversity; social disclosures, labor practices, human rights, community engagement, product responsibility; and governance disclosures, board diversity, executive compensation, ethics, anti-corruption, tax transparency. These reports showcase sustainable impact. Slide 19. Key performance indicators. Effective KPIs in integrated reports balance financial and non-financial metrics. Examples include percentage carbon reduction, employee retention rates, CSR investment, and women in leadership roles. KPIs should be relevant, measurable, consistent, and aligned with organizational strategy to demonstrate progress toward long-term value creation. Slide 20. Business model and value creation. An integrated report illustrates the business model's transformation of inputs, six capitals, into outputs, products, services, byproducts, waste, and outcomes, impacts on capitals. This narrative explains how resources are deployed to generate sustainable value for stakeholders over short, medium, and long-term horizons. Slide 21. Real-world examples. Real-world. Tata Group pioneered integrated reporting in India, linking strategy, KPIs, and stakeholder engagement in a cohesive value creation story. Mahindra & Mahindra adopted to highlight sustainability with science-based targets and transparent governance. Both demonstrate how integrated reports enhance accountability and investment decision-making. Slide 22. Key takeaways. Chapter 5 equips you to apply specialized reporting frameworks, segment reporting under IND AS 108, interim reporting per IND AS 34, and integrated reporting. Mastery of these enhances transparency, supports informed decision-making, and promotes sustainable practices within modern financial environments.